Welcome to Ask the Expert, a web series designed to provide you with practical information on business and finance. I am your host, Nicole Pride. Our very special guest today is none other than Hasan Pride. Yes, we share the same last name. If you don't know, Hasan is my husband. I confess I have been holding out on the Ask the Expert community, but today I have invited Hasan to share his wealth of experience with you, and I'm so happy he's joining us today. Mr. Pride is a vice president of commercial banking at Valley National Bank. With more than 20 years of experience in commercial lending, he has covered a full range of commercial transactions, including underwriting, small business loans through the SBA, the Small Business Administration, and managing portfolios of large multi-million dollar middle market clients and everything else in between. He is also a volunteer with SCORE. SCORE is the nation's largest network of business mentors, which is sponsored by the U.S. Small Business Administration. So Hasan, I am so happy and delighted to have you here today and to share this experience with you. Welcome.
Yeah, thank you, Nicole. Good to see you as always, and thanks for having me on your show. Thank you.
Yes. Okay, so let's just start with SCORE. So can you tell our audience what SCORE is all about?
Yeah, absolutely. So like you mentioned, SCORE is the nation's largest network of volunteer mentors with over 10,000 mentors across the country operating out of maybe about 1,500 chapters. And SCORE mentors, they vary. So SCORE mentors, some are retired executives, some are retired entrepreneurs, and then there's persons like myself. I work full time, but volunteer with SCORE on a part-time basis.
Yeah, I had personal experience, as you know, with SCORE. SCORE is an excellent organization. I recall when I had my nonprofit, shout out to Jane. Jane was my mentor many years ago, and she provided just a wealth of information, and she was just so helpful and encouraging. So any of you who need mentors and support, SCORE is an excellent organization for that. And so can you talk specifically about your role with SCORE and how you help business owners?
Yeah, absolutely. So as I mentioned, with 10,000 mentors, the backgrounds of SCORE mentors vary greatly. You know, we have some individuals who may have experience in marketing, others who may have backgrounds in the food and beverage industry. So me personally, given my background in lending and finance, I generally help clients who have questions surrounding things about financing their business and starting up and creating business plans. So that's really my area of expertise, although I can certainly assist other clients in other areas based upon my experience within SCORE and interacting with other SCORE mentors. But we all have different areas of expertise, and our goal is to help the SCORE clients. So if there's an area where I lack, then I'm happy to pull in another SCORE mentor who has whatever experience that entrepreneur needs. And similarly, other SCORE mentors pull me in when they have questions about financing and business plans, things of that nature.
Yeah, I love that about SCORE. I recall that too. When working with Jane, I needed some expertise in the areas of copywriting. So she connected me with a copyright lawyer. I think someone with taxes, I don't recall now, but there were different experts that were coordinated through my one mentor. And I think we should mention, if we haven't already, that SCORE is free, correct? For
Absolutely. Just about all of the services that we provide are free.
Excellent. Yeah. So for our audience today, if anyone would like to learn more about SCORE or to sign up to get a mentor assigned to them, how should they go about it?
So I would recommend anyone visit the website of score.org. And there, the way it's structured is that you can reach out to a mentor in your local area by entering your zip code and the website, and then the website will find the local chapters near you. But particularly given after the pandemic and that most of us work remotely now, you really have access to a SCORE mentor across the country. Many SCORE mentors allow themselves to be available to mentor clients wherever they are in the nation. And so when you go to the score.org website, there's an area where you can press find a mentor. And then based upon your specific needs, your specific questions, you can find a mentor that has the background that would fit whatever it is that you're trying to accomplish.
Excellent. Wonderful. So, Hassan, let's get into it. With your background in underwriting in the past and your commercial lending background, let's talk about loans. I'm sure there are many people who are listening today who either are considering a loan or they think that that is their best course of action or maybe in the process of applying. So, and applying for loans could be someone's default, right? They think they need cash and they're like, I need a loan. So can you talk to us about when someone should really consider applying for a loan?
Yeah, so this is the way I look at it. If we think about what happened in 2020 with the pandemic, we found that there were a number of individuals who may not have had access to obtain the PPP loan. There were companies who otherwise would have been eligible, but because they didn't have access to a banker, a lender, they missed out on those opportunities. And so
And can I
for
interject? Can you
yeah,
just describe the type of loan that you just referenced for everyone?
yeah, the PPP loan was the paycheck protection loan that the government provided during the pandemic to assist businesses who were experiencing revenue losses and to help them get through the pandemic by supporting their payroll. And what I usually recommend for small businesses is to have some type of loan facility in place. And what that looks like is generally a line of credit. And even if you don't want to use the line of credit, sometimes there may be a cost associated with not using it. But still, I recommend that companies who are able to obtain at least a line of credit at a bank so that you have it available when you need it, or so that you have access to a banker when you need to interact with that banker. Hopefully, we never experience anything like the pandemic in our lifetime again. But for whatever need that may arise, I think it's important to have a connection with a banker so that whenever anything does arise and there's a trigger where you need to obtain a loan, you already have some type of connection in place.
So if I hear you correctly, you're advising business owners to basically have the line of credit before you actually need it. Is that correct?
Absolutely. I think there's, you know, before you need a loan is when you should access it because, what becomes problematic where I think a lot of business owners, they tend to reach out to a bank when they need a lifeline, and that's not what banks are there for. So a company may find that they're, for whatever reason, maybe experiencing revenue loss or showing losses on the bottom line. And then that's when they think that they should reach out to a bank or a financial institution to apply for a loan. But that's actually kind of the worst time to apply because we don't have crystal balls. And so what bankers are looking at is the past performance of the company. And that's what we generally use to determine the financial capacity of a company. And so if you don't already have a connection with a banker, it just makes it that much more difficult if you try to reach out to a banker when your company is struggling.
Wow. So there's two things that you said. One, the thinking about your relationship with banks and bankers, right? So you said most business owners think about banks in terms of needing a lifeline when they're in trouble, and they're looking for the banks to help bail them out. And so I think that's like a mindset shift that many owners probably need to have and adjust.
Yeah, yeah. I mean, I wouldn't say most, but there are a considerable amount, particularly for individuals who are just starting out, um, and they don't have that history with the bank. So that's kind of the mind frame. There's a lot of companies that do fairly okay by bootstrapping a business, but again, when it comes to time for a need, it can be problematic.
And so you mentioned a couple of times that you should have a relationship with your banker. So that might be new to some folks. What does that look like? And how do you establish a relationship with a banker?
Yeah, you know what? That's an excellent question because it, you know, every relationship is different. Depending where you bank. We have here in New Jersey, uh, when I last checked, there's over 100 different banks and credit unions that do business in New Jersey. And I'm not just talking about physical branches. I'm talking about over 100 different entities that provide financing that do business in New Jersey. Some are large companies where if you try to obtain $1 million loan, it's probably considered too small for them. And then there's small community banks where a $600,000 loan is probably going to go to a credit committee. And then there's everything in between. So the relationship looks different at different institutions. And so what's important is that most companies probably have a deposit relationship at a bank because that's how they're paying their bills, is to reach out to your whoever it is at your bank to find out who that person is to connect to who services a business like yours, of your size, of your industry. There may be specific verticals within a bank that services your type of business. And so you just want to reach out to your particular bank to see who that person is and have lunch with that person or have a meeting with that person. you know Alternatively, networking is something that still works. I would recommend going to your local chamber of commerce events. Typically there are bankers at those events as well, and just introduce yourself and have those conversations. And if that person at that event isn't the right person, then you want to ask who at their institution could be able to assist you. So there's nothing wrong with having a conversation, even if you don't have a need right now, but you want to get connected and just educate yourself uh, before that need arises.
Great. That's basic networking 101, right?
Yep.
And it applies to your banker as well.
Absolutely.
Excellent. And so, okay, I'm a business owner. I've listened to you in the past, and I should get my line of credit in advance. But what is it that bankers are looking for when I get to the point where I'm either asking for a line of credit or asking for a loan?
Yeah, so there are some documents that are just typical regardless of who's asked what type of business is asking for a loan. So typically a bank or a financial institution, they're going to want to see the business financials. And for most small businesses, we're talking about the tax returns. Some small businesses may have compiled statements done by a CPA, but as businesses get larger, there are more complex documents that a CPA would do, like review statements, or for large businesses, they do audited statements. But typically for small businesses, clients that are coming to score, they're usually the tax returns is what they have available. So a banker, lending institution, they're going to want to see at least 3 years, at minimum 2 years of financial history of the company. And then in addition to that, most small businesses are going to have their principals guarantee those loans. So any individual who owns, let's say, 20% or more of that business, they're also going to have to provide their own personal financial information. So in addition to the business tax returns, those individuals will have to provide the last 3 years of their personal tax returns. In addition to, there's a document called a personal financial statement. And what that essentially does, it just lists that individual's assets and liabilities. So they're going to have to provide that as well, along with the business financial statements. And then, every transaction is different. So there's going to be particulars surrounding that transaction. For instance, if we think about a real estate transaction, in addition to the financial statements, you're going to have to provide, if you're looking to purchase a property, you're going to have to provide the purchase agreement for that property. That's going to list all the details, the price and location of that particular property. So any particulars that surround that transaction, you're going to want to provide as much information as you can to help that lender underwrite your loan.
Mhm. That makes sense. And is there a general rule of thumb about how much someone should ask for? Is it for the specific need down to the penny or a certain percentage above that? What does that look like?
Yeah, that's a great question as well. And so I'm going to contradict myself here a little bit. So earlier I talked about, just getting a line of credit, even if you don't need it. But typically when you apply for a loan, a banker is going to ask you what that need is for. So when you're seeking a loan, you want to understand the cost of whatever it is, that project that you're looking to finance. Typically when people look for lines of credit, they're saying it's for working capital, and it's kind of like a coverall reason for
Mhm.
a line of credit. But when we're talking about real estate loans and term loans, um, there are specific costs to that, and most institutions don't finance. So there's two parts to this, right? So most institutions don't finance 100% of term loans and real estate. So there's a particular equity portion that you have to inject. So if you're thinking about real estate again, I think I like to use real estate because it's just easy to think about. Um, First of all, there's certain regulatory reasons why a bank cannot finance 100% of a real estate transaction. But I would think that you can consider adding about 30% equity into a real estate transaction, a commercial real estate transaction. So if you're looking to purchase $1 million building, then your loan amount will probably be about $700,000. So that's one part to consider. But the other part to consider is, does your business have enough cash flow to service the debt on that $700,000 loan? So there's two parts. Just, one, you got to know what the total costs are, but whatever that loan amount, your business needs to be able to demonstrate that it can service the monthly or whatever periodic payments on that loan. So if your cash flow from your business isn't sufficient to cover the loan payments on a $700,000 mortgage, that loan amount would be reduced to a level where your cash flow demonstrates the ability to service the debt.
Got it. And does the same apply for someone or a business owner who would like to invest in, let's just say, equipment, or they see that they want to grow their business and they want to support their marketing efforts? What does that look like?
Yeah, so similar. there are institutions that you would find that would do 100% of equipment. Again, like I said, there's 100 different institutions, and you have to do homework and have conversations to see what your bank or what there's fintech organizations out there, what opportunities are out there for financing. Um, so it's the same concept if it's term loans, but in terms of when we're thinking about like equipment purchases, your business may be in a growth mode. And so that's why you need that new equipment to support that growth. You may have run out of capacity with your existing equipment, and so you need this additional equipment to expand.
Mhm.
So what I would, recommend in that case is, even if your business currently isn't demonstrating the ability to service that debt, you add a business plan and projections, and you have a conversation with the banker to show, okay, right now, this is where my business is at. But however, when I add this new equipment, this new product line, we're going to be able to increase our revenue and cash flow by X amount. And that way we'll be able to service the debt. And so through your business plan and your conversations with the banker, as long as it's reasonable, you know, you can work with the banker to say, okay, I don't have it now, but projecting a year out, I will have it. And if it's reasonable, that's something that banks take into consideration.
Perfect. Got it.
Mhm.
And you talked about some of the good reasons of applying for a loan. What are some reasons that you've heard of other clients or wannabe clients who wanted to apply for a loan and maybe their loans were denied because they weren't really the best reasons for applying?
Yeah, so in SCORE, we get a variety of clients who come in with different levels of experience. And, a lot of them are excited, and sometimes they put the cart before the horse. I think that's the term. And so they kind of jump into situations without really thinking it all the way through. Maybe they didn't do a business plan to think about the ramifications of things. And so, I think when clients, sign a purchase agreement for a property and didn't really think things through, like maybe leasing is the better way to go for their new startup business, as opposed to just entering into an agreement to buy a particular property. That's something that I've seen. The other thing is when clients are looking to get bank financing to plug the losses in your business. That's not what banks generally do, as I mentioned before. So if your business is experiencing losses, revenue declines, that's not a situation where a bank is going to come in and put good money after bad money. So those are kind of the situations where, I wouldn't recommend getting financing.
Right, because banks they're in business too to make money, right? So if they
Yes,
can't get a return, right,
absolutely.
yeah.
You know, it's an investment. It's not an equity investment into the company, so there's no equity stake, but it's an investment nonetheless. That loan that a bank is providing, and they're going to want their return as well as the principal that they provided to the company. So, if a bank is, I'm sorry, if a company is experiencing losses and declining revenues, that just creates that much more of a risk to the bank getting their um, principal or even interest back.
So what are some other funding sources that companies should consider?
So the one thing about banks, um, when it comes to financing, banks are great because generally speaking, they have the lowest costs in terms of financing sources. There are plenty of other different ways that companies can finance their business. Think about credit cards. Credit cards, some businesses do, but that
Remember, we're a
comes
D3 here.
and we're right, exactly. You're right, and so to my point, those are high interest rates that are associated with credit cards. There are fintech companies that individuals can Google. Um, there's the SBA, the Small Business Administration. So even though a SBA loan, the SBA doesn't actually provide the loans through banks and other organizations. What they do is they guarantee those loans. And so through the SBA 7A program and the 504 program, individuals could look to obtain financing in those areas. And then there's what we call CDFIs, Community Development Financial Institutions. And these are institutions, these are generally nonprofit institutions that provide microloans. And these nonprofit organizations, they're typically funded by the government, and they have the directive to get money out to small business owners. So that's another source that I tend to recommend my SCORE clients to go to.
Do you find with those loans, are there particular industries that the government supports through those community development corporations, or it runs the gamut?
Yeah, it covers a range of industries. So yeah, I wouldn't say that there's any particular industries that are preferred over others. But typically, what I will say in terms of the SBA in general, we get a lot of clients that, think about opening restaurants, and restaurants have the dubious distinction of having high turnover, high failure rates.
Mm.
And so a lot of banks don't finance restaurants. However, the SBA does. So many restaurateurs go through the SBA program to obtain financing for their startups, or if they've been in business for a few years. That's the way to go for bank financing, for I should say for financing. Another
Are there
option.
any other industries that traditionally banks kind of shy away from?
Yeah, so I mean, if we think about the recent surge in cannabis, businesses,
Mhm.
banks typically don't finance the cannabis industry.
Hmm.
There's actually levels to it. I won't go into it through here, but particularly if the business actually handles the cannabis, it's generally tough to get financing for those type of businesses.
But they're
Um,
popping up all over the place. How are they getting their funding then?
the cash from the investors generally.
Mm.
So in general, for many entrepreneurs and for small businesses, particularly startups, it's the equity from the owners is the way that financing occurs. But again, even if you can't get financing from a bank, people tend to look to investors for
Mm.
funding. And those investors, different from a bank which provides loans, those investors are going to just ask for equity.
Got it. Yeah. So we're going back to bank loans. Can you just talk about loan terms and conditions, and what are the factors that um, contribute to the fees, and are there hidden fees that people don't know about?
Mhm. I
Yeah,
always like
it's
that, the hidden fees, right? So it depends on the situation. So if you're financing a piece of equipment, that equipment has a certain useful life associated with it, and it's really a number of years, 5, 7, 10 years. So if you're looking for a term loan to finance that equipment purchase,
Mhm.
That loan is going to match the useful life of that asset. And
Okay.
so a term loan is going to typically have a term of about 5, 7, or a maximum 10 years. When we think about real estate, going back to real estate example again, that real estate has a significantly larger, longer useful life. And
Mhm.
so you can typically get longer financing terms for real estate than you would for a piece of equipment. Um, so, you know, some banks provide financing as far as 25 years on real estate, some even 30. Um, Most banks generally will amortize, and when I use the words amortize, it's thinking about the amount of monthly payments that would go over a certain period of time. So they would amortize a loan over 25, 30 years, but the actual term will be shorter. So a term will probably be 5 or 10 years. So when that 5 or 10 years comes around, then the remaining loan amount would just balloon, and that business owner would probably have to reach out and obtain financing either with the same institution or somewhere else.
So, is there wiggle room for a business owner to negotiate terms, or how does that work? Yeah.
Now, that's a great question, and negotiation is all a part of it. And
Mhm.
so, if a business owner is in a position where they have more leverage, then they can negotiate better terms.
Meaning
Uh,
they have more assets, or what does that mean?
you know what? That's a great question. It could be a variety of things. So, if a business owner is showing that they have a lot of assets, that they can use for collateral. They're showing cash flow that's way more than sufficient um, to service that debt. Many banks, many financial institutions, they're going to want that business owner as a client. And so, with more people looking to finance that business owner's um, project, they have more room to negotiate better terms. And
Mhm.
as a banker, I don't like when we issue a term sheet to a client and then they pit my term sheet against someone else. But for my score clients, I typically recommend, hey, if you're in a position to do so, go ahead.
Meaning you're going through the process with multiple lenders and whoever gives you the best deal.
Right. And when we're talking about small business clients, so through my day job as a banker with Valley Bank, I manage a portfolio of middle market clients. And these are
Mhm.
larger clients who have scale, and with that scale comes structure and resources. So they may have a team of people to facilitate the lending process. Typically, small business owners, they're the CEO, they're the CFO, they're the garbage person, they do it all. And
Mhm.
so it's challenging to go to different financial institutions to
Right.
negotiate and deal with that process. I mean, some may hire brokers, but then that's an extra expense that sometimes isn't needed. So you got to think about what resources you have available to, and time is money. And so you have to consider all that in terms of how much time you're going to spend with reaching out to various different banks and negotiating. Although I always recommend for our score clients not to just look at one bank. You do want to have different options to compare so that you know that you're getting the best deal for your particular situation.
So, what's the process like in working with a broker, and what are the fees like for that?
So I really can't speak to that too much. You know, Back in 2005, I worked for an organization where we did a lot of business with brokers. And so there wasn't really a cost directly to the clients that would come in from the broker, but what the broker would do, they would add their fee and build it into the loan amount. And
Got it.
so the financial institution that I worked for at the time, we would actually pay those brokers. So we'd increase the loan amount to cover those broker fees.
Got it. Okay. So you talked a little bit about some of the trends with different industries, but is there anything in particular that you want to leave us with in terms of what the outlook looks like in commercial lending?
So we're still in a high interest rate environment, and when there may be companies who have taken out loans 5 years ago, and those loans may be coming due for a reset, and if those businesses aren't demonstrating sufficient cash flow to service the increased debt payments that are associated with these rate resets, they may, find that their cash flow is going to be squeezed a bit. And so that's the challenge if you look just industry wide in the real estate market is, we have a lot of debt that's coming due and coming for a rate reset. And so those business owners are experiencing higher costs associated with refinancing that debt. Fortunately, the thought is that rates are going to be coming down soon, and so that will help some. But right now, we're still in a higher interest rate environment, and companies, this is real money going out the door, and so companies are experiencing the pain somewhat.
Okay. I don't know. I feel like we need to leave our audience on a higher note. That was
Yeah.
that wasn't encouraging.
Yeah.
But this has been really good, Hasan. Thank you for
Mhm.
coming out. This
Of
was like
course.
a lot of good information that I think will be really useful for our community. So we appreciate you. I appreciate you for taking time out of your very busy schedule to do this with us today.
Well,
Thank
I'll
you.
do anything for you, Nicole.
Oh, okay. We got that on film. It's documented.
That's
You
right.
heard it. All right.
All right,
All
dear.
right, everyone. That's today's episode of Ask the Expert. So we look forward to seeing you same time, same place next week. Thank you.
Thank
Bye.
you. Bye.